Good afternoon, everyone. Welcome to our Advance Iowa at the University of Northern Iowa webinar on worker cooperatives. We're excited to have you here with us this afternoon. My name is Patrick Linsman. I work at the University of Northern Iowa's Center for Business Growth and Innovation in Advance Iowa, and I get to be your tech support host for today. So real quick, as we get things started, if you have questions, please enter them into the Q&A box. We will be able to answer those hopefully throughout the session today. This is being recorded, so if you have to step out for a minute, you can always get the recording from us. We'll have it up on our website and on YouTube, and you can come back and check it and see what you missed. And then if you want a copy of the slides, let us know, and we can make sure we share those with you today too. So with that, we'll jump right in. I'm going to introduce to you our host for today. We've got the Director of Advance Iowa, Dan Binkin.
Hey, Patrick, thanks as always for being here with us and running Zoom, because at this point I would be lost without you, obviously. And thank you to Jenny Massal for joining us as well, all the way from beautiful Providence, Rhode Island, although not as beautiful as Cedar Falls, Iowa. Just throwing that in there. Yep, that's right. That's right. Thank you to everybody who's joining us today. Our focus is going to be on worker co-ops. I know you didn't come on here to hear from me, so I will keep it brief, but we have recently been awarded some funding to help promote, advocate for, and just generally get education out there about what's kind of a cool way to organize a company that I think most all of us have never heard of before in Iowa, or if we have a lot of misnomers about what a worker co-op is. And Jenny is here to set us straight. So we're all thinking about the co-op in our hometown, the giant concrete elevator type of thing. And while those are obviously co-ops as well, what we're going to be talking about today is a different type of worker co-op structure that any company could organize themselves into. A lot of flexibility in a worker co-op. We'll hear about that today from Jenny. So Jenny is director of the, I'll just say, the worker co-op programming at the ICA group, and has actually worked for and thus been an owner of a worker co-op in the past. So she comes with firsthand experience and has helped lots of companies go through the transition process to become a worker co-op, as well as helped other companies in that start from scratch mode of starting up a new company as a worker co-op. And so we're excited to have her along with us today. Jenny, take it away. Thank you very much.
Cool. Thanks so much, Dan. It's really great to be here with you all today, and excited to talk about worker co-ops, which, as Dan said, is a really flexible form of employee ownership that I think can be a succession option that can make sense for a lot of different types of businesses. So in terms of the agenda for today, I'll introduce myself a little bit more and really want to start by talking about exit planning and exit options for small and medium-sized businesses before getting into a particular option for exiting your business through a sale to a worker co-op. So kind of talk more generally about exit planning and exit options, then really dig into what is a worker co-op. I have some case studies of other companies that have gone from transitioning from sole ownership to a worker cooperative model as part of the owner's exit planning. And then want to share a little bit more about the process of what it looks like to explore one of these transitions at your own business. And we'll leave plenty of time for questions at the end, but also want to encourage people to use the chat, interrupt to ask any questions you have as we go through the content. So in terms of the ICA group, we are a nonprofit organization based in Massachusetts. I work remotely in Providence, Rhode Island. And as an organization, we work nationally to support companies in transitioning to employee ownership. So I direct our work providing consulting services to businesses in many different geographies and industries who are exploring or pursuing these transitions. And that work involves everything from working with an owner to really identify what their exit goals are and assess whether employee ownership is an option that can meet those goals. For those where that seems like it could be a good fit, I work with the business to determine a financial transaction for the sale to employees, and then work with employees to plan for actually taking over the business and executing the transaction to a worker cooperative. So oftentimes, most of the businesses I'm working with, I'm connected to because the owner is starting to think about their retirement or their exit from their business. As Dan affirmed at the beginning, most business owners have never heard of a worker cooperative as an exit option. That's pretty common in my work with the people I'm talking to, but it's also pretty common that people aren't totally aware of many of their options for their exit. And so our work really starts with connecting with owners who are thinking about their exits and trying to explore different options and compare how employee ownership relates to those different options and really kind of figure out what might make the most sense for that particular owner and that particular business. And I think we also see that many owners don't spend a lot of time thinking about their exit until they have a real sense of urgency over it. There's a lot of reasons for that. As you all know, running a business is a more than full-time job. Business owners are busy with the kind of day-to-day operations of the business. It's harder to focus on long-range planning. And I think on top of that, it can be emotional and challenging to think about an eventual exit from the business. A lot of the owners I work with have a lot of their identity kind of tied up in the business, and thinking about separating that identity can be daunting. But we really come to this work from the perspective that thinking about exit planning can help to ensure that you receive a fair return from the sale of your business, really thinking about all the money and resources you've invested into your business and how to get a fair return from the sale. Also recognizing that as business owners, you've created jobs and you provide essential goods and services to your community, and exit planning can help ensure that those jobs and services continue to exist after you leave. And when we talk about exit planning, pretty generally, we're just talking about that at some point, every business owner will leave their business. And that exit planning is really about identifying your target departure date for exiting the business, both maybe from ownership as well as day-to-day responsibilities, any financial needs you have from the sale of your business, a succession plan for how your responsibilities will be transferred, as well as assessing the value of the company and how the current value compares to your own financial goals. And that by creating an exit plan, doing that advanced planning and goal setting, business owners can transfer ownership while assuring that their goals can be achieved. And so in terms of ownership transition options, we see that depending on the industry and geography, there might be a number of options for a business owner, or there could be very few kind of succession or transfer options for them. Some exit options that can exist include acquisition by another company, a sale to an owner-operator, which basically means someone who would take over both the ownership and the management of the business, a sale to key employees, like maybe a manager or a management team. So for the purpose of distinguishing from the worker co-op idea, we call that a management buyout. Oftentimes, people are familiar with the idea of a sale to family members and then a sale to employees. And again, distinguishing a sale to employees from a sale to managers as being like a broader group of people, maybe irregardless of their position in the company. All of these options have different advantages and challenges. And so a good first step in exit planning is understanding what options exist for your type of business and the implications of those different options. So for an example, an acquisition could be a type of exit option that maximizes financial return for a business owner. but it often comes with the feelings of having to sell to a competitor or maybe a large chain, depending on your industry. And sometimes we see that businesses in certain industries or certain geographies get acquired just to be broken up into parts or shut down after the acquiring business has kind of received the customer list of the business they just acquired. So just kind of understanding the activity going on in your industry is a helpful first step to understand which options might be available to you. And so now I'm going to talk about a form of employee ownership in particular called a worker cooperative, which is the type of employee ownership that I specialize in, but is just one type of employee ownership. I think a lot of business owners that I initially connect with have considered employee ownership and are most familiar with a form of employee ownership called an ESOP, or employee stock ownership plan. So an ESOP is an IRS qualified retirement plan. Basically, there's a trust that's set up that buys, holds, and sells company stock on behalf of the employees. It's a highly tax-advantaged form of business ownership in terms of federal tax and usually state income tax breaks for ESOP companies. But because it's a retirement plan, it's also highly regulated. So those regulatory requirements make it costly to administer. And so what we see is that people are initially drawn to the idea of an ESOP because they like the idea of employees owning a business, but that the regulatory requirements and the costs in relation to that can make it prohibitive for companies of a certain size. So if you start to explore ESOPs, you'll see that there are a lot of different benchmarks that people might share of what size your company has to be for an ESOP to make sense. Basically, what you're trying to assess is like, do the costs of administering the ESOP on an annual basis, are those less than the tax savings you're going to get from being an ESOP, so that you have that kind of tax advantage and financial savings, even with this cost of administration. What I've experienced is that you'll hear a lot of different benchmarks, but it's all really specific to your business situation, whether an ESOP could make sense. But just so there are outliers to these rules of thumb, but some rules of thumb that we hear are that for an ESOP to make sense, a business has to have earnings measured as EBITDA of $500,000 annually. You have to have 100 employees or more. Another rule of thumb we hear is that you have to have federal taxable income of at least $50,000. Again, those are just benchmarks, and there are exceptions to those, and you'll hear some slightly different benchmarks, I think, from different players in the ESOP space. But the basic challenge we see is that for smaller companies, it can often be cost prohibitive to pursue an ESOP. And so a worker cooperative compared to an ESOP is just kind of straightforward, a business that is owned and controlled by its employees. Typically that like Class A common stock of the company is owned by the employees. It's not a retirement option, it's direct ownership. We'll get into what that means, but because it's not a regulated retirement plan, it ends up being a much more flexible and affordable option compared to an ESOP. It's not governed by complex retirement plan laws, doesn't require annual appraisals, trustees, or third-party administrators, which are all requirements of an ESOP. And it's really flexible. So some states have worker cooperative specific state statutes that allow for worker cooperatives, but worker cooperatives can literally be any legal entity. You can create the right governing documents and elect to be taxed as a cooperative with the IRS. So it's a super flexible model and form of employee ownership, which in our experience can make it an appealing option to business owners when an ESOP doesn't make sense as the form of employee ownership for their business.
So Jenny, for that, you know, what you just said there is basically for our audience, you can operate as an LLC or an S Corp. Those are probably the two main paths that people would choose, I would think, in very much the same way as they would, exactly the same way as they would register an LLC or an S Corp otherwise through our Iowa Secretary of State's office and processes there. And there's more information on that on our iasourcelink.com page. I'll give a plug to Patrick there if he's listening in, I don't know. But as far as the tax treatment, and I know this isn't a tax webinar or anything like that.
Yeah.
Just at a very high level, with an LLC, normally everybody who is an owner of that LLC, the distributions and salaries and things would get parsed to their Schedule C, right? And show up there if they're LLC. If they're S Corp, they do a K-1 form in a more traditional corporate return, which is why most people do which is why a lot of people do the LLC. With this added layering, so to speak, of the worker co-op, now our dividends and earnings, whatever you want to call them, that are shared by the company, they don't flow through probably passively to a Schedule C. They go onto a different form that we would file then as an individual. How does that work at a high level?
Yeah, so it's helpful that you're mentioning both LLCs, which by default are taxed as partnerships under sub K of the IRS taxation, and then S Corps, which are taxed under sub S. Both of those are considered pass-through entities, which means that all of the profits and losses of the company are allocated to the owners at the end of the year. They might not be paid out to the owners, but they're allocated to them, and those individual owners report their share of the income and their share of the profits, and their share of the losses on their tax returns. Subchapter T is the IRS tax code for cooperatives. It's based around kind of agricultural cooperatives, but you could also use it, and many worker co-ops do choose to be taxed under Subchapter T. The primary advantage of Subchapter T is that it allows for the flexibility of both corporate taxation and some of the benefits of a pass-through entity. So in a worker co-op taxed under Subchapter T, the worker owners can continue to be paid wages as W-2 employees. Yep. And at the end of the year, the company's profits can be allocated to individuals or can be allocated to the cooperative as a collective, and the cooperative pays corporate income tax kind of as a C Corp on that income. And in that way, it allows some of the money to not necessarily belong to any individual. So you can kind of balance the needs of the co-op and the needs of the individuals. The profits and losses that are allocated to the owners of the worker cooperative under Subchapter T are tax deductible for the company. So unlike a C Corp where dividends to shareholders are double taxed first at the corporate level, then individual shareholders pay income tax, Sub T allows that to be tax deductible at the co-op level, and members receive what's called a Form 1099 patronage, PATR, where they report those additional allocations of profits and losses from the co-op. So they're typically kind of continue to be paid as W-2 employees, and then where the ownership comes into their personal tax situation is around any profits or losses that have been allocated to them as patronage is the word for that.
Patronage.
Yeah.
I like that. Okay, thanks, Jenny.
Yeah, totally happy to dig into more about the taxation, and we have some resources on that on our website that I can point people to as well. So yeah, in terms of a worker cooperative, the basic idea is that it's about shared ownership of the company by its employees. So again, it's typically that Class A common stock of the company that's owned by the employees. And one of the rules for that share of stock is that only workers can become owners. So you have to be an employee to become one of the employee owners of the company. This doesn't mean that that every single employee has to become an owner or gets to become an owner. The company's governing documents, whether that's its bylaws for a corporation or its operating agreement for an LLC, lay out how someone becomes an owner. So most companies will structure it so that after working for a period of time for the company, you are eligible to become an owner. Other companies structure it so that you have to have worked there for a period of time and get voted in as an owner by the other existing owners. So there's a ton of flexibility, but the basic idea is that the employee group is the group of people who have access to ownership. The workers become owners, which we call them worker owners, member owners, or members, by purchasing what's called a membership share. And each worker can only own one membership share of the company. So unlike other ownership models, someone couldn't put in more money to own more of the company in a worker co-op. And the final kind of piece of shared ownership is that profits and losses are distributed annually on the basis of what's called patronage, which is a measure of how each worker contributes to the company. So this is typically measured as hours worked, where like everyone's wages are kind of based on the salary scale of the company. And then at the end of the year, any two full-time workers are kind of entitled to the same share of profits, and maybe twice as much as a half-time worker. But again, it's really about how the company lays out in its governing documents that it's going to measure patronage, this measure of how each worker contributes to the company. There's a lot of flexibility in creating the formula for annual profit sharing. And then, as I was saying, around the taxation, a lot of flexibility in balancing allocations of profits to the individual workers that they're entitled to, versus keeping that kind of at the corporate level for the co-op's ongoing kind of capital needs. So shared control of a worker co-op is where I think we get the most kind of misconceptions about what a co-op is. A lot of images come to mind for people of like everyone sitting in a room making every single decision together by consensus, which means no decisions are ever made. I think there are some worker co-ops that operate on a collective basis, but in general, it's a pretty common misconception that worker co-ops are businesses where everyone's sitting around together making decisions. Most co-ops that we work with and most co-ops kind of in the country have pretty traditional management structures. So I think some of the basics of what shared control means is that financial information gets shared a little bit more openly with worker owners, not necessarily everyone's salaries or every single detail of the financials, but kind of high-level financial statements. And ideally, you're doing training with workers to have them engaged with that financial information to help improve and grow the business. As the worker owners, the member owners of the company, the workers are the primary shareholders of the company. And so they have a vote on shareholder matters. Just like any other corporation, those are the biggest decisions of the company that require a shareholder vote. Those are things like a decision to dissolve the company. As corporations, worker co-ops have a board of directors, and that board is elected by the other worker owners to represent their interests within the co-op. Many co-ops structure their companies so that the board is made up of a majority of worker owners. And so worker owners can also run for the board, but there's also a ton of flexibility here, kind of a mix of companies that have outside directors join the board of directors. Again, all of that gets outlined in the company's governing documents and is figured out in terms of what makes sense for each company. So a lot of flexibility.
Yeah. In reality, there are not all that many decisions that actually make it to ownership level for vote or even discussion and conversation. It sounds like from kind of what you're saying. I mean, you mentioned the example of dissolving the company. That's a pretty extreme decision to, right? And there aren't many others that are of that level. So I'm guessing it's more about capital structure types of things and merger and acquisition types of discussions than it is, should we hire this person to become a member owner or day-to-day.
Totally.
Yeah, okay. So that's something to keep in mind, is that although we might have 15 owners of our company, of our worker co-op, we're not, every decision on what color of pencil to buy and what to have for lunch isn't run through some sort of democratic board or a process, but there's a very
right
hierarchical
decision. And there's like thresholds for the decisions. I think so. You could take an example of like spending a large amount of money. Maybe it's a landscaping company that each year needs to spend around $200,000 in, capital expenses for new vehicles or equipment or things like that. Typically, like the general manager or the management team of the company is empowered to make that decision. Let's say there's a year where like something goes awry and maybe the company actually needs to make a bigger investment in capital expenditures, maybe 600,000, something much higher than what its norm is. That might go up to the level of the board of directors for decision making. Okay. And then what if like the landscaping co-op is like, oh, we could spend $3 million and merge with this other landscaping company? That might be kind of a big enough kind of question of like survival and future of the co-op that you would have the member owners make that decision collectively. But you have these different tiers, the management of the company, which could be a general manager or CEO, it could be a management team, you have a board of directors, and a lot of kind of the decisions are delegated to them by the member owners, to the management for a lot of the day-to-day operational things, and the board for some of the kind of bigger strategic decisions of the company.
Okay. That makes sense. Thanks for kind of walking through that a little bit.
Yeah. And so the worker co-op field is fairly small, especially compared to the ESOP world. There's around 400 worker co-ops in the United States that employ 8,000 employees. And so again, it's common for people to have maybe not encountered a worker co-op before. But these companies range in size from 2,000 employees. That's the largest worker co-op. It's called Cooperative Home Care Associates. It's a home care agency in the Bronx in New York. Sorry about that. And then, as small as a handful of employees, 3 to 5. And they're represented in a lot of different industries, as you can see. So even though people might not be initially familiar with the idea, it's often possible for us to connect kind of every business that we work with to kind of a comparable worker co-op in their industry. And there's kind of a good database of a network of worker cooperatives to help make those connections and show what this can look like for other businesses in the same industry.
Is it a misnomer on my part to think that the better fits for this type of a structure have a lot of folks wearing a very similar hat, doing a similar role? When I think about home health care, child care, those types of places, that's what I think about, or sometimes in the skilled trades too. Maybe is that I'm sure it's not a requirement, obviously, but is that a general trend that you see where a lot of the folks are kind of doing the same types of things, making the same types of money?
Yeah, it's a good question. I think there are a lot of worker co-ops in fields where people are kind of doing team-oriented work together. So there's a lot of like general contracting co-ops,
okay,
construction, landscaping. I think there's a lot of energy in creating worker co-ops in industries with low-wage jobs as a way to kind of create better quality jobs. So you see a lot of that in home care. That's a lot of our work in the child care industry. Okay. We also see a lot of like professional services. So architecture firms, engineering, graphic design. I think some places where it gets trickier are where there's like very differentiated licensing requirements within a job. So like we've worked a few times with veterinary clinics, and each state, it's kind of like, well, are non-vets allowed to own a veterinary clinic? It varies by state. Or like a psychology practice or a medical practice, where some of the people working at the business are regulated professionally and other people are kind of back-end support. There can be some challenges there around creating a worker co-op structure.
Okay.
Yeah.
I was curious. Thanks. And if there are questions from the audience, please put those into the chat at any time, and we'll definitely cover them as we go here. And so please just know that that's available to you at any time here. Thank you.
Yeah, totally. And so of those worker co-ops that exist, that like 400 number, a bunch of them start out as worker co-ops kind of from the beginning. That's how the founder structured the company. but there's also a long history of companies transitioning, or what we call converting, from more traditional ownership, where the business is owned by a single owner or two partners, to worker ownership. And there's a real growing movement around these types of business conversions, a lot of city and state kind of economic development support. And one of the primary reasons for that is because we support business owners who are transitioning their businesses to worker co-ops for a number of reasons, but I would say the primary reason is we're working with owners who are nearing retirement age and are looking to retire from their business. And so this is a big reason there's a lot of economic development support for this type of work, because as baby boomers who own the majority of small businesses are starting to retire, there's kind of this question of what's going to happen with their businesses, and a real kind of emphasis on trying to maintain those businesses. And this is one way of doing that. I think importantly, there's also some common misconceptions about ESOPs, and then that trickles into the worker co-op space, that selling your business to your employees is really about gifting the business to them. We can talk a little bit more about that, but I think we work with a lot of business owners who want to receive a fair price for their business, and this is one way where they can sell the business for a fair price. We work a lot with owners who want to exit the business intentionally over time, and this model allows the flexibility for that in a way that some other exit options, like maybe an acquisition or a sale to an owner-operator, wouldn't. We also work with owners who want to explore a different business model. Sometimes they've been the sole business owner and are kind of ready to stay involved, but don't want to kind of continue with the full weight of ownership. They want to share that responsibility with other people. A lot of the owners we work with, recognize the value that their employees have brought to the company and want to reward them or provide access to ownership for them. And we also work with a lot of owners who, are very attached to the business legacy they've created, and they want to continue after they exit. And so, one of the other kind of common misconceptions we hear, and one of the first questions we get is like, my employees can't purchase the business. They don't have the funds to do that. We hear that a lot, again, working in some of the lower wage industries we work in, like childcare.
Yeah.
And like ESOP transitions, most transitions to worker co-ops are leveraged deals. And so this means that employees are not coming up with the money out of pocket to purchase the business from the owner. Instead, the employees are forming a worker co-op structure. They'll take out a loan from a co-op friendly bank to purchase the business from the selling owner. The seller typically also holds a note with the co-op for a portion of the sale price. So just like 20% of, or that, just like how seller financing is involved in most business transactions, it's also common in the conversion to a worker co-op. And so then the worker co-op uses its profits to pay back the debt after purchasing the business over time. So employees are putting in some money in the form of their contribution to purchase the membership share, but those individual employees, aren't trying to get a personal bank loan for the business. It's kind of the company being underwritten by these co-op friendly banks, looking at the cash flows to make sure that the business will be able to pay back the loan on the purchase over time. So we can talk more about that in more detail, but just like oftentimes we talk to people who are like interested in the idea and immediately feel like there's not going to be a way financially for the employees to purchase the business. And that's a lot of the work we do with owners, is to figure out how the transaction could come together.
I think that's a great point. No, you're fine, Jenny. Thanks for bringing that up. I think that's a great point, is that most owners feel like their employees could never afford to buy them out. I know what I pay these people. There's no way they can, etc. So what my key takeaway here is, we're not going to go down to our local corner bank or whatever in our community. We're going to seek out, I think it's the CDFI network or others, right, within that kind of specialized space of worker co-ops, of which there aren't nearly all that many of them around, but certainly if they want to get referred to one of those types of banks, they can work through us and you to get some names and ideas on who they could talk to. What about on a startup side? Let's say that 3, 4, 5, 10 folks wanting to get started are more of a startup than an existing business conversion. I'm guessing when they go
Yeah.
to, purchase
Yeah,
it.
the co-op, yeah.
Go ahead.
The co-op banks that we work with also lend to startups. I think it's a different type of risk and investment for a bank to make in a startup versus a conversion. In a conversion, there's theoretically an operating history that shows financial success, and there's a way to show that financial success can continue under the new ownership of the employees. And so there can kind of be that confidence in the future cash flows of the company. I think for a startup, it's a lot of that business planning to really project out what the profitability of the co-op might be. If you think about a business sale where it's 80% bank financing and 20% seller financing, that seller financing in a conversion is kind of seen as some of the equity that maybe workers aren't putting in themselves. And so that doesn't exist in a startup, right? There's no kind of seller's note that goes along with it. And so I think it's just about figuring out different ways for coming up with some of that additional financing, because it's unlikely that it would be 100% bank finance. So that could be employees putting in a larger amount towards their membership share. That could be the co-op raising loans, kind of like friendly loans from family and friends that are subordinated to the bank loan, things like that. So the lenders work with both types of businesses. I think there's just kind of different underwriting criteria that goes into the sale of a business versus a startup.
Cool. Okay. Again, a lot of flexibility and opportunity. Okay.
Yeah. So I wanted to share a couple examples of some companies that have gone through this process of converting from traditional ownership to a worker co-op. One is a company called A Yard and a Half, which is a landscaping company out near me in Waltham, Massachusetts. They're a design, build, and maintenance company, so kind of do a lot in the landscaping industry. It was established in 1988, and it had 20 employees at the time that they transitioned to a worker co-op. It's a pretty successful company in the top 15% of landscaping companies by size. It had $2 million in annual sales. And the owner of A Yard and a Half was a woman, Eileen, I think was her name, who began planning for her exit in 2012, targeting 2013 to fully exit. She wanted to exit daily operations, kind of give up all of her ownership, but was willing to stay on as a consultant to kind of support the workers on the other side of the transition. She wanted to sell the business for fair market value and was open to seller financing, some portion, but limits to how much. And in terms of management succession, she built a really strong leadership team. She began building up a management team 10 years prior to the transition. She'd also implemented some practices that kind of feel similar to a worker co-op. She practiced open book management with her employees, so was sharing financial information. She did annual profit sharing, had a lot of systems for employee feedback. So kind of culturally had set up some systems that supported also some of the culture of a worker co-op. And kind of through this leadership team planning they had done, they decided that there'd be two co-managers who would take over kind of the top leadership role of the company when the owner exited. She also had non-financial goals, some what we call legacy goals. She wanted to reward employees for years of hard work. And she really, felt a lot of pride in A Yard and a Half's services and their reputation within the landscaping industry and within the kind of Boston metro community. And so she really wanted to ensure that continuity of the business brand and reputation, and knew that her employees who were so enmeshed in that brand and reputation were probably better equipped to do that than like an outside buyer coming in. And so in 2013, 10 of her 20 employees purchased the business to operate as a worker co-op. Here, the financing came from a few different places, a regional co-op lender called Cooperative Fund of New England, which is the CDFI in New England that lends to co-ops. She held a seller's note for a portion of the sale price. The company also raised some kind of subordinated loans from family and friends at just kind of like lower than, bank interest rates. And each worker owner also contributed $7,000 towards their membership share. That was the cost of the membership share. I would say that's a little bit on the high end. We're used to seeing that membership share costing between $1,000 and $5,000 per worker at a company. We've seen it go up to as much as $35,000. We've seen it as low as, $50. So here, worker owners were putting in, $70,000 through their membership shares. And then employees also participated in training over that year of the transition period to build their skills and develop the tools to run the business. So that's one. Yeah, go for it.
They're now more than employees; they're employee owners. So they're getting some help and assistance in thinking like an owner, I'm guessing, and that kind of a deal too.
Totally. Yeah.
The loans from family friends is the curious one for me. So would this deal not have happened without that, do you think? And maybe you don't know enough of the specifics. Do you have to have some third party lending like that within your deal to make it happen?
No, it's not super common that this happens. I think there are examples where Real Pickle is kind of a famous example. They're a pickle company out in Western Mass that did a crowdfunding kind of investment share. They crowdfunded investment shares to help purchase the business.
Yeah.
I would say it's definitely less typical than just kind of like a combination of like seller's note and primary bank lender. I think the benefit of that option, that kind of third party, is that that's probably going to be the cheapest form of debt. I think we think of the bank debt as coming with an interest rate that's going to be the highest, and so. Because they're leveraged transactions, there's this real assessment we have to do of how much debt can the business take on and reasonably afford. And so I think for some companies, it's worth the effort to try to minimize the cost of the debt. And that's kind of a lot of the work we do, figuring out the right transaction structure for a company. But I would say this is it's less common than more common in these types of transactions.
Okay, cool. Thanks,
Yeah,
Jen.
does not need to be that many people all coming together. Yeah, so the other example I have is a little bit more standard. This is the Rose Garden, a child care center in Buffalo, New York. The owner, Judy, had thought that her daughter, who worked at the center, would maybe take over as the owner, kind of a family succession option. And her daughter had kind of seen what it was like for her mom to be the sole owner. And she liked working collaboratively with her coworkers, but she didn't want to own the business by herself. And Judy knew that her business could maybe be kind of an attractive option to a large childcare chain, but was worried about what would happen to the culture of the center if she sold to a chain. So this transfer to a worker co-op helped her realize her goals of preserving the feel of the center. Her daughter was able to become one of several worker owners instead of the sole owner. So this transition took a little bit longer. She began planning for her exit in 2016, targeting 2019 to fully exit. Knew that she wanted to exit daily operations, also willing to stay on to mentor teachers, kind of similar financial goals to a yard and a half of being open to some seller financing and really just wanting to get fair market value for the business. She started planning for her management succession closer to the transition date. She stepped out of the director role in 2015 and her assistant director became the director. She also started training her staff in some of the kind of non-classroom business management responsibilities of the company. And again, like Yard and a Half, really wanted to reward her employees for the years of work with the business and also wanted to elevate the early childhood profession. again, a lower wage industry, and saw this as an opportunity for workers to have access to, additional profit building opportunities through business ownership. So the Rose Garden worked with 2 cooperative development organizations, the ICA group and a local organization called Cooperation Buffalo. 5 employees became the initial employee ownership group. And here 70% of the financing was secured through a co-op lender, a CDFI called the Working World, and 30% was provided through a seller's note. And a lot of the work that the co-op development organizations do, like the ICA group and Cooperation Buffalo, is all about kind of leading trainings and skill building with employees about kind of the skills to run the business as a worker co-op. So this kind of financing breakdown of like 70-30 is more common, just to a seller's note and a bank in the mix, as opposed to the yard and a half example where there are other sources of financing.
Okay, cool.
Yeah, so just wanting to be mindful of time. I think the final thing I just wanted to talk about is the process for exploring this at a business. We definitely approach this work as it takes time to explore and can be worthwhile to explore, but it still might not be right for every business. And so we really say that we start the process with the business owner, really working to establish their goals for exiting the business and assess whether employee ownership is an option that can meet those goals in terms of their financial needs, the timeline, any other non-financial goals they have for the sale. We also want to make sure that it's a feasible option for the owner and for the business on the other side of a transition before we present the idea to employees. So we want to know that it's financially feasible, that there's a sale price that can meet the owner's financial goals, and there's a financial transaction that can meet their goals for cash up front, and that financial transaction, that the business will be able to afford it and afford the debt moving forward and have a healthy business on the other side with some profit sharing potential for workers. And we also want to know that it's operationally feasible, that there's a way to take everything that the owner has been doing for the business and have that kind of work continue on the other side, whether that's having to hire a new person, whether that's training up current staff. That looks differently in every company, but that second step of assessing feasibility is a lot of the work we specialize in and really focus on doing with an owner before getting to a place of, making the decision for the owner to move forward. If after kind of going through all that, an owner has decided that this is an option that seems like it can work for them, is when we start working with the employees to plan the transition. That's everything from figuring out kind of some of the key governance decisions, like how does someone become an employee owner? What will the board of directors look like at this co-op? It's digging more into the management transition plan and planning for responsibilities that need to be transferred. And it's kind of doing financial education around the transaction structure and kind of aligning around how the business needs to perform moving forward in order for the business to cover the transaction. We also work with the company's lawyers and accountants to execute the transition and work with the company to secure any financing needed for the transition. And then just kind of in recognition that this is a big change for a company to go through, we both want employee-owned businesses to celebrate when that transition happens, and then also to continue to build skills to support successful employee ownership. And so a lot of our work, we kind of stay involved with businesses immediately following their transition to do things like financial training, board training, things like meeting facilitation, just to keep building those skills and make sure that the business is successful as a worker co-op. So I want to leave time for questions and can get into that now, but just want to share that our website has a bunch of resources on worker co-ops that I would encourage you to look at, icagroup.org/resources. And then we're also partnering with Advance Iowa to be able to talk individually one-on-one with any businesses in Iowa who are interested in talking more about like could this make sense to explore at your business? And so if you're interested in having one of those conversations, you should get in touch with Dan, and we'll schedule some time together. So yeah, really great to be here. Appreciate getting to talk to you about worker co-ops, and happy to answer any questions people have.
Great. This is awesome, Jenny. And I got a couple of questions that came in. One of them is on the daycare side in the childcare industry. Sometimes those are set up as nonprofits. Is there a way for them to consider and look at transitioning from what might be that nonprofit status into a worker co-op, or for any,
Yeah,
for that matter?
yeah. Well, we get this question a lot.
Okay.
There are ways to structure a nonprofit so that it emulates some of the factors of a worker co-op. Like you could have a membership nonprofit where the members are the workers and they elect the co-op or the nonprofit's board of directors. But inherently a nonprofit doesn't have owners, so the workers can't be the owners, the shareholders, and have like profit sharing rights in a nonprofit. So it's a little bit hard I think you can do some of the like cultural stuff of a worker co-op in a nonprofit setting, but fundamentally a nonprofit can't be a worker-owned business because it doesn't have ownership as a nonprofit.
Okay. So they would have to dissolve.
Yeah, and so that's the other thing. It's not impossible to transition a nonprofit to a for-profit company, but it does, just like require a legal process around all of that.
Do you see that happen very often, or is it more? I know that you have a specialization in the childcare space. 90% of those companies as startups, or?
Most of the childcare companies we work with are already for-profit businesses, usually an LLC or an S corp, and they're converting to a worker co-op. Yeah, we definitely sometimes get connected to nonprofit childcare centers, but it's like not quite the right fit for what we do.
Sure, no, that makes sense. Thank you. Maybe another question too on that. On taxes that we got in was about rates and things like that. When the dividends are dispersed through the pass-through vehicle, whatever it might be, or into the Schedule T, they're just taxed at the regular rate of whatever that individual's income tax rates are? Is that correct? Or
they're taxed as personal income. Yep.
Okay, cool. Those are the two questions I got, Jenny. I don't see any more. So maybe we can wrap up here. This is awesome. I appreciate it.
Cool. Yeah, thanks for having me.
Yeah, thanks for everybody for being with us. And we will talk soon. Have a great rest of your day. Have a great rest of your week. Thank you. Bye-bye.